Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, April 8th, 2016. First, a programming note: we're going to have a presentation by Marie Felberg. She's a psychologist and life coach, entitled Psychological Aspects of Trading, the Rule of 21. So please stay tuned until the end of the video, and she'll have a presentation for you. S&P 500 ETF SPY broke the rising wedge formation. Now what? So we'll look at what to expect in the near future. I think the long-term picture for S&P 500 and stocks in general still remains bearish, and I think this is being confirmed by the bonds breaking out to all-time highs. The dollar is struggling at support, and this is helping gold. While oil bounced back for the week, but for how long? So we'll look at some of the longer term patterns for oil as well. And we'll finish off with an analysis of natural gas. Okay, so this is S&P 500 ETF SPY. So we had a pretty powerful rally of the February lows here up to basically this level here at 207.14, and then since then we kind of corrected somewhat down to sideways. Now I think this was a this rising wedge break right here in beginning of April, and since then we attempted to regain the rising wedge, but so far has failed. Especially today on Friday, this action here kind of shows that there is quite a bit of selling already happening. So in the morning the prices, actually this was Thursday close right here, so on Friday the price gapped up, and then throughout the day it continued to sell. The selling continued throughout the day. So another very bullish looking candle. Most likely, we're going to see some maybe sideways consolidation. I mean, my bias is bearish, so I'm only looking for bearish setups. But the market really has this way of just frustrating pretty much everybody out there. So maybe we'll just make an all-time high, or maybe we'll collapse from here completely and take out this low here. Or maybe we'll just trade sideways, and neither the bulls nor the bears will have the upper hand. So at this point of the game, like I said, my bias is to the downside, but pretty much anything can happen. And think about it this way, the all-time highs are not far off. They're like just above this levels here. So if you're buying up here, your upside potential is kind of limited, because there is resistance up here, and people, traders will be selling into resistance. So if you bought up here, your potential is just a few points here, while the potential to the downside is significantly higher, because there is lots of room for it to fall. There is some resistance at the major moving averages, but down below, of course, we can see there's plenty of opportunities to go down. So to me, this is definitely not a place to be buying, and I'm only looking at shorting opportunities, of course. Down below there are some unbalanced volume indicator, some of the breadth indicators. They're really not showing much difference from last week, so not much difference from last week, really. This is a long-term chart of S&P 500 going back to the 1996 here. What I did is I removed the price and I only left the moving averages in place, the 50 and the 200 day. So up here we have what's called market breadth index, and this is an index that I created which includes various breadth, momentum, and participation indexes and indicators sort of rolled into one. So what I like about it is it gives pretty consistent and timeless signals as far as the long-term market timing is concerned. So, for example, here in 2001 we had a bearish signal right here, and then we had a bear market from 2001 till 2003. Then here in 2003 we had a bullish signal right here. etc. So you can see that pretty consistent signals. But what I really like about it, in addition to calling them major turning points, is that it also helps to determine if these corrections here, for example, in 2010 and 2011, if they were true bear markets or were they just mere corrections. And you can see that they were mere corrections because on neither of those occasions we had a breakdown in this indicator. So as of right now, from 2015, from about September, I believe, this indicator is calling a bear market. So so what I'm saying is basically I'm looking for only shorting opportunities, and until I see improvement in market breadth, and it definitely will show up in this indicator, I'm going to continue looking at only bearish setups and bearish opportunities. Okay, this is S&P 500 going back about a year back. This is also showing the market breadth index in the upper part here, and I just want to show a zoomed in version of the previous chart. You can see an entry into the bear market here in September of last year, and since then pretty much I didn't see any improvement so far in the market breadth picture. This whole rally here, I considered it a bear market rally, and my subscribers shorted it. So you know, we were short going into the beginning of this year, and actually we rode this entire leg down. I still think that this is a bear market rally. You know, again, because I just don't see a significant improvement in market breadth just yet. Some market breadth indicators up here as well. So for example, here this is percentage of stocks above the 20-day exponential moving average, and sometimes it gives decent signals. So for example, here in November you can see it dropped below this point here about 40%, and pretty much then we kind of unwound and continued lower. We're kind of getting to that level right now. So we'll see if this signal will be also a good signal. All right, this is a long-term chart. This is a weekly chart going back a couple of 3 years, and I just wanted to show a quick Fibonacci retracement. So if we say that this last week rather was the high for the move of the lows in February, then we could expect a correction down to 38%, 50%, or 61.8%, which is, it's called a Fibonacci cluster. So if we do pull back, this could be the levels to watch. And if we get below 1913, I would say that this rally, I guess, is over, and we could retest the February lows again. This is New York Stock Exchange Composite Index, a very broad measure of the United States stock market, and this one looks even weaker than the S&P 500. You can see all-time highs back here in 2015, and then ever since then basically nothing but series of lower highs and lower lows. And in my definition, this is a definition of a bear market. Additionally, from this all-time high to this actually multi-year low, this is 20% decline. So we could say that this is, technically a bear market, because we have a technically 20% decline of the lows. So if we say that this is a bear market, now this rally becomes pretty much clear as a context for within the context of a bear market, and looks like we're getting this rejection at the 200-day moving average right here. Maybe we'll struggle some more. Maybe we'll form kind of like a head and shoulders pattern. Maybe we'll another attempt at about 10,200, and then a leg down possibly. If we take out this multi-year lows, we could move down significantly lower. Like I pointed out, this potential inverse head and shoulder, and I don't think it's correct, complete yet. This is only 6.2%. The depth of this pattern is 10%, and usually the least on the downside could be 10% after the breakdown. But now we have potentially even more to the downside if we roll over and break these levels from February. Similar picture down here. All right, we're looking at TLT, the Treasury Bond Fund. Very bullish chart in my opinion. So we had several breakouts here and here, and then moved to all-time highs and a pullback in a form of, I think this is a rising wedge or a flag. Now here we had in March, we had a breakout and continuation higher. I think we're about a percentage point away from all-time highs, so this is clearly a very bullish action. This is also showing, I think, risk aversion as investors are rotating into bonds and most likely away from stocks. And also this is pretty much, TLT, the treasuries are pretty much the ultimate safety asset. The United States government most likely will never default on its debt, and one way or another they will pay their debts. So again, this is bullish action. The next chart shows a longer term picture for TLT. This is a 3-year chart going back to 2014. We had a run up to all-time highs in 2015 and a pretty deep correction into 2015. But then we had a rally, again hit all-time highs just in February, coincidentally as the markets unraveled. We're again gaining onto this all-time high. So this could be a possible, I guess this could be a cup, and maybe this is a handle. And if we do get a breakout above 135, then the depth of this pattern could be duplicated on the upside. So this is 20% depth. So imagine 20% more gain for long-term treasuries. Most likely stocks would be under severe pressure if the treasuries break out to all-time highs. Moving on to AGG, which is a diversified bond fund. Similar picture, but I think AGG is even stronger than TLT. You can see there was a couple of breakouts here and here, all-time highs here, but then correction also sort of in a wedge pattern and a breakout. But now we had another breakout to all-time highs just last week and continued to yet more all-time highs this week. Again, this is showing quite a bit of risk aversion in my opinion, because this is bonds and they don't move as much, so people sitting in bonds really are most likely waiting for something bad to happen to stocks. Next chart shows also a 3-year chart for AGG going back this 3-year chart. So kind of similar to what we had for TLT, but not as deep of a correction here in 2015. It was only 3%, while TLT corrected 20%. So TLT is actually surprisingly volatile. It's even more volatile than S&P 500 ETF SPY, based on the standard deviation measures. But in any case, pretty powerful move here in 2016, and this is all-time highs. Again, the depth of this pattern is 3.4%, so if we do get duplicated on the upside, this is already about 1% up, so if we continue higher, this will be another 2% higher. So, again, this is, in my opinion, showing risk aversion and rotation away from stocks. Okay, this is US dollar daily time frame going back about a year. So we kind of trade in this big range here from about 100 to around 92, and for the past few weeks we've been coming down to this level here of 94, which corresponds to the level which held support here in October, and then there was a rebound which almost took out a 52-week high. Now, if we don't hold this level here at 94, 93.80, we could come down even further down to the, what I call this, a critical support level, and this corresponds to the last May levels and the last August levels for the dollar index. If that happens, I'll show in the next chart. This is the US dollar on a weekly time frame. You can see that this is the level I just showed at 93, 92.50. And if we take out this level, there's pretty much nothing but white space down below, and most likely this breakout will come into question, and most likely will retest this breakout. If that happens, we'll see most likely euro gaining and possibly Japanese yen gaining even further. This is already 52-week highs for Japanese yen, but the euro is sort of trading in a sideways pattern, and maybe it will also break out to new 52-week highs. But for now, we're kind of trading in this falling channel. So if this is indeed a falling channel, we could also say that this whole thing is a cup and handle pattern. We can just turn around and make a breakout above the lip of this cup. If that's true, then we'll see another most likely 9% up for the US dollar index. So we see, there's a possibility for quite a strong move either way, especially if we break this support or come back out and break out of this channel and possibly continue higher to 52-week highs. Okay, so we're moving on to the commodities part of the presentation. This is gold weekly, and this gold price is in yellow here, and this is going back to 1996. Even if you know nothing about these two charts, you can kind of visualize that they move sort of opposite to one another. If the yellow chart rises, then the green one is falling, and green one is the US dollar. So you can see that they are clearly oppositely related. So one rises, the other one falls. And down below here I have a 20-week coefficient, correlation coefficient for gold and US dollar, and you can see they're strongly negatively correlated. The coefficient spends most of the time in the negative territory. So lately the relationship has been holding, and you can see that the dollar is falling while the gold has been rising. Anyway, so that makes perfect sense. Next chart will continue on to gold itself, and this is a these are 52. This is actually multi-year lows, and then we kind of came up in a sort of a cup and handle pattern, broke out and continued higher, had another breakout, and then continued close to 52-week high. So now we're sort of consolidating in this sideways range. For the record, I am now bullish on gold. I was bearish up to I think around here. But then next chart I'll show my market breadth index for gold, and it has indeed flipped into the bullish territory. So to me, this, since I'm bullish on gold now, I'll be looking for buying opportunities, but to me this does not represent a good value right now. I would be looking to maybe buy gold if it drops some more, because right now it's just clearly not, I think it's overbought right now basically. So if we do come down a little bit, maybe I'll look for some buying opportunities for gold. Alright, this is gold spot price weekly chart going back to 2011. Down below here we have what's called gold breadth index, which is a experimental indicator that I created. Similar to market breadth index, it attempts to find a bull market versus the bear market in gold, and it signaled entry into the bear market back here in 2012. So this rally here was already a bear market rally, and if you knew it back then, you would have shorted it. we had multiple breakouts, or rather attempts at breakout, but they all failed, and you can see that none of the times this market breadth index for the gold flipped into bullish territory. Now the final breakout here just this February did indeed result in a flipping of the GBI into the positive bullish territory. So now I'm treating gold as a bullish security. Okay, this is GDX, the gold miners ETF. Same thing, I have a gold breadth index up here in the upper chart here, and part of the chart. This is the time when it flipped into the bullish territory, and from here on, I consider gold to be in a bull market. So I'll be waiting for a pullback for a GDX to consider a long entry. Now it's been really volatile. You can see there was just a lot of back and forth with large gaps. Another huge gap here. This could be a breakaway gap, by the way, if we just continue higher. Alternatively, we could just, come back and fill this gap, because there was a lot of, this type of gaps here, and just sideways trading, sideways chop. These are also 52-week highs already, so GDX is stronger than gold itself, I think. Market breadth is available for GDX, and I think it is confirming the breakouts. You can see higher highs in advanced decline lines and in on-balance volume. Now, this breakout was not on very high volume. You can see it's below the average volume, so maybe this is a breakaway gap, but judging by the volume, it's not a terribly high volume, so we'll see if it is a breakaway gap or if it just gets filled right away. All right, moving on to oil. This is daily chart and light crude oil, West Texas Intermediate. We had a pretty volatile week, really. Last week we kind of came down pretty hard from the 200-day moving average. This was a pretty powerful and clear rejection. Came down to about 35.24, but then turned around and really made a strong recovery. I mean, this was, almost 5.6% in just one day. So we kind of came to this resistance level from these two peaks here from the late March. I think the bigger resistance now is at the 200-day, and you can see that there is this long stick, and we kind of closed above it. This is volume by price, by the way. And this volume by price here kind of corresponds to the 200-day moving average. So I think we may spike again, maybe in the form of a shooting star candlestick to the 200-day moving average. So we'll see if it gets rejected again at that level, and then if the shorts come in and push the prices lower. I still think that this is a bearish chart, and I don't think this is a sustained recovery just yet. All right, this is natural gas, also spot price daily chart. Also quite volatile security in general, and this week was really volatile too. Basically, we had a spike that was rejected at the 2074 here, and then we kind of came down, but then we had on Thursday we just had a huge run up, and then again kind of came down on Friday. So for the week really was not much of a move. We just kind of stayed in the same place, but the movements were quite violent, and natural gas, this is how it is. So if you decide to trade it, you have to really be careful with position sizing, and probably trade very small if you decide to trade it. Anyways, I think that the resistance level here is at 2172, so we may see a run up again and maybe attempt to recapture this area. There's a volume by price bar as well at this level, so it would make sense for the bears to come and try to push the prices lower. Further up here, of course, there's another level to watch, is a 200-day moving average, and this peak here, so that's a resistance level. But I think even a bigger resistance level is at $2.50, and the next chart will show why. Alright, this is a weekly chart of natural gas going back 3 years, and I showed this in the past several times. Uh, I wanted to point out this resistance level of $2.50, multiple touches to this level here, breakdown here in last year, and then attempted to rebound there, so far failed. So if we don't get rejected, as I showed in the previous chart, we may actually run up to $2.50. This will be a very important test. If natural gas manages to break out above this level, then most likely I will treat it as a bullish security. For now, I'm still treating it as a bearish security. We have some bullish divergences here that actually are continuing, so that's something to kind of keep in mind, and it's possible that we're seeing a bottoming action in natural gas. That's it for this week's recap. Please stay tuned for Marie Feldberg. She's a psychologist and a life coach. She'll be presenting in just a few minutes. Thanks for watching, and have another great trading week. Bye-bye.
Hello, traders. My name is Marie Feldberg. I'm a clinical psychologist and life coach, and I'm here today to teach you a technique that I hope will help you improve your trading. If you can relate to how this guy feels, then this video is likely to be useful to you. We're going to talk about the rule of 21. We psychologists have known for a long time that it takes approximately 21 repetitions of a behavior to form a habit. On the other hand, it takes 21 instances of avoiding a behavior when you want to do it to unlearn a habit that you have but don't find helpful. Habits have everything to do with trading. You know that no system is always right, but you still risk more than you can afford to lose, and when it inevitably happens, you blame the system. That's a habit. You know that people who stick with the system do better over time than people who do not, and still you set the rules only to break them. Problem? You have a habit of breaking your rules. Solution? Build a habit of sticking with your system instead. Now, how do we build a habit of sticking with the system? First thing you do is you get ready. Make sure you understand how your system works before you start. If you learned it from somebody, ask them questions. Get everything nice and clear. The second important thing is keep your positions small until you get the hang of this. That way, even if you make a mistake or if your system doesn't work out, you will not be devastated. Next, resolve to follow your system religiously for 21 trades. If you slip, don't be hard on yourself. We're all human, but start over. We need 21 system-compliant trades in a row. You will know the habit is established when sticking with your system becomes easy. In the beginning, you will really have to struggle to force yourself to do this unfamiliar thing. But as you repeat, as it starts to become a habit, you'll notice it takes less and less effort to overcome yourself and stick with the system. You will also start to notice that you feel optimistic when you open a position. You won't be so anxious. You won't be losing sleep and breaking out in a rash. You will be hoping that it will work. When and if a trade fails, you will not despair. Once you have a habit of sticking with the system, you will also have faith in it, and you will just cheerfully wait for your next opportunity without spending all your free time worrying about your trades. I hope this primer helps you improve your trading processes and outcomes. If you wish to learn more skills for trading, or if you have questions about this one, drop me a line and I'll try to answer any questions you have. The next slide will have my contact information. You can freeze your screen and copy that down. If you find this extremely helpful and you really want to learn more, You can hire me as your life coach, and then you'll get focused one-on-one instruction where we will concentrate on the specific issues you may be having and select techniques that will be most helpful for your situation. This is how to get a hold of me. I hope we'll speak again soon, and have a wonderful day.
Dr. Feldberg, thank you very much for your input to this blog, and we certainly look forward to your future input, and I'm hoping that your input will help other traders to improve their game. Thanks very much. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. If you have Twitter, Facebook, YouTube, StockTwits accounts, you can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye-bye.